meantime, I want to bring in Mike Santoli, CNBC senior markets commentator, and Sarat Sethi, portfolio manager at Douglas C. Lane, and also a CNBC contributor. Mr. Santoli, your instant market reaction.
The big banks numbers are kind of monotonously good right now. I mean, the Fed keeps talking about the economy's in a good place.
Monotonously good. That's a good phrase.
But I think it's a no bad surprises story, and it's going to be consistent. I think the market has a better appreciation for that right now. I mean, B of A was up 1% yesterday on the back of the other guys' earnings. So I do think that the valuations are getting rebuilt. It's all about how long you think this expansion goes. The banks are fine in that context if, in fact, you think it persists for a while as the markets are now handicapping.
The train's left the station.
The train's left the station.
It's barreling down the track.
But they're still not expensive. So let's just dial back here because there was so much talk about going into earnings season, especially for banks. Expectations are high. Stocks had run. You know, Bank of America was up 40% last year. But if you go back to 2018, that fourth quarter was so bad for all these banks because wealth management business, trading business, any activity in M&A was all pretty much 0 to negative. So I think it's a catch-up to that, and then these stocks ran ahead of it. Now this is good to see a 6 cents beat by Bank of America. JP Morgan had good numbers. Wells Fargo was the anomaly. Kind of, we all expected that. You got a new CEO.
Do you think that was kitchen sink on Wells Fargo?
That's definitely kitchen sink, and probably a little while to go. So
then it's not kitchen sink if we haven't gotten everything out. Like
so we're not in Wells Fargo, and I think it'll be a while before.
And you wouldn't be. Because some people actually looked at that as a bullish sign. I know that's a very counterintuitive thing to think.
It is a bullish sign if you think the rest of their peers are really expensive. But you've got really high-quality companies. Bank of America's catching up to JP Morgan. They've got really good diversified businesses. And, you know, if global picks up, these are the companies that you want to be in as well because you've got a strong consumer, you've got M&A starting to pick up, and you've got a global exposure here in all these.
Yeah, what you get with Wells Fargo, I mean, the stock is not super cheap at all relative to the other big guys, except on a dividend yield basis. So if you care about that, it's above 4% dividend yield. If you think they're close to bottoming in terms of the fundamentals, then okay, you get a little more income.
So you can look at Wells as more buying a bond at 4% with some volatility.
The call option in it.
But the offset of that is if the banks do go down, that's going to go down with it as well. So I think you're better off playing in high quality. Valuation matters. These are good companies to own.
Let me just ask you one other sort of more related question on the banking front. We had a couple different bank analysts come in here, and they said, we wouldn't really touch any of the big banks anymore. We'd actually much prefer to be in the super regionals or even the smaller regionals. Right. Does that make more sense to you? Given where the prices are? I mean, given how we're talking about where the train is?
So, as a whole, the financial sector trades below the market multiple.
Right.
But I think you pay up for quality when you've got something like a JP Morgan and Bank of America. I do think there's some regionals to touch. I mean, we own First Republic. That had great earnings yesterday, but it trades at a high value. You have to worry about regionals because their focus is basically all on lending. They don't really get the wealth management. They don't get some of the other M&A that these other banks get. I do think you can be in there. They are cheaper, but they're cheaper for a reason. You just have to be careful because what is credit quality? We're going to find out those earnings. U.S. Bancorp's coming out today, and you got some of the others. We're pretty well diversified. We've got 20% of our portfolio in financials across the board. So I don't think you avoid it. You just have to pick your spots on it, just like you want to avoid a Wells Fargo situation.